right, folks. Hope everybody had a great Thanksgiving holiday weekend, whatever, but we're back. And yours truly been busy, doing a lot of videos for you. And this one is the first one of the batch, but then we have the Sunday video coming out this evening, and then we got, of course, earnings reviews on top of Maverick portfolio updates. And then we have many more, but if you were told me, look, Maverick, you gotta do something here. The number one video you gotta do is how not to blow up your account. We have a lot of options traders, and unfortunately with options, if you don't know what you're doing, you're probably going to end up blowing your account sooner than later. It's just a matter of time here. And the reason behind that is a lot of options trading is speculation. And of course, there is a difference between educated speculation versus a thin line between speculation and gambling. What happens when you go to the casino is you sit down at the blackjack table and you play a little bit and you get the beginner's luck. You make a lot of money, but you don't walk out of the casino. Why? Because you think you got it now. You come back. Even when you get your wins, you come back, you sit at the table again, and you want to replicate the success that you had from the beginner luck. It's a sweet taste in your mouth that you can't let go of. The problem is the game is rigged, and the odds are against you. And the longer you play, the more likely you're going to lose your money because you have no strategy, you have no idea what the next card is going to look like. So you sit down and you lose it all. And the same thing happens in the options market. You initiate a trade, you get a beginner's luck. All of a sudden you're making 100, 200, 300% in a single trade, and you want to replicate that. And you take more risk. You go all in. You want to be rich quick. And you get in one bad, one nasty trade. It's over. So we got to go back to the viewer who said, Maverick, you got to do something here, put out a video. What I got to say to you is, if you're going to gamble, you're going to lose. Without me, it doesn't matter. If you're taking too much risk, playing weekly call options, put options, way out of the money, going all in, all of these are bad behaviors because the odds become probably 80, 90% against you. It's a fool's errand. You're going to lose. Whatever wins you have, it's just luck. And it's just a matter of time before you lose it all. Okay, so with that out of the way, is there a trick? Is there a template that we can use to avoid getting into a game where the odds are 80 to 90% against us? Can we get in a game where the odds, let's say 55 to 70% in our favor? The answer is yes. And any options trader, no matter how good they are, they got losing trades too. That's just part of the game. So right off the gate, you know that if you put all of your eggs in one basket, you're not really trading, you're gambling, you're probably going to lose your money in the long run. That goes without saying. What we know is, in options trading, a huge part is art, picking the structure, the strikes, the time, the entry point, the management, all of this is art. There are no specific rules here, but there is science to it. I will talk about the science part in this video right here. What if I told you that before you get into any trade, you gotta fill out this template that you're looking at right here? Now, of course, I'm gonna say Maverick, but this is not fun anymore. All I know is just log into Robinhood, a few swipes here and there, and boom, we're in. This is too boring. Of course it is. But this is what makes the difference between who stays and who blows up their account in just a matter of time. And bear in mind that the success of any options trade, I would say about 70 to 80% before the trade even takes place. So this is what we're trying to do here. I'll give you this template right here. We'll give you an example. I'll give you a homework. And let's see if you can learn something here and change your mentality a little bit. Before initiating any options trade, you need to look at the technical setup, decide what potential trades do we have, decide an entry strategy, a cut-loss strategy, a time strategy, and lastly, a management strategy if the trade is working your way. Now, the management strategy, that's going to be another video. We're going to talk about the rest of them right now. And the example that I got for you this video is Apple. So if we look at the hourly chart of Apple, what do we see here? We see a pattern of higher highs. That was broken last Friday. Now we have perhaps a pattern of lower highs. We have what it appears to be a bear flag pattern. We got support at 188.57. We know that because repeatedly the chart treated that line both as support and resistance. So we know that this line is important. And then we have a gap below. As you can see, gap number 1. We have gap number 2. And that's enough for us in the hourly chart. We look at the daily chart. We have what it appears to be a topping candle, followed by confirmation on Friday. So we're going to use the Fibonacci retracement levels here from the bottom to the top. We can see that the first retracement, which is about a quarter of the move that we got, would be in or around 186.5. Okay, we'll keep that number in mind. And then we have the weekly chart for Apple. What do we see here? Perhaps a topping candle. We've seen this before repeatedly. Maybe this is going to lead us all the way in the weekly chart down in a retest to the 20 weeks moving average, in or around 181. So let's go back to the template here and fill what we found out. On the hourly chart, bear flag pattern, broke the pattern of higher highs, and support is at 188.57. Then we have gap number 1, which is between 185 and 186.30. Then we have the other gap below, between 182.48 and 183.58. On the daily chart, we have a topping candle, followed by confirmation, and the next Fibonacci retracement is 186.5. Weekly chart, we have topping candle, and the support will be at the 20 MA at around 181. So far, so good. So we have the technical setup says that the chart is topping and ready for a pullback, maybe more. So what potential trades do we have? If we look at the numbers that we got from the hourly and the daily, we have a pullback trade. If we follow the hourly and the daily chart, we know that 188.57 is an important line to break to have another confirmation to enter the trade. But what support do we have for the trade to be done, the pullback support? So we have gap number 1 between 185, 186.30. And then of course on the daily chart, we have the Fibonacci retracement at around 186.5. So we know the 186.5 is an important number here, and it could be the target for any pullback, at least stage number 1 for any pullback. So any pullback trade that we're going to eye, we're going to look at 186 as the support. And in options trading, you can go a little below that, below the number. So when you pick your strikes, it's probably going to be 185. That's going to be okay. If we look at a larger trade on the weekly chart, a correction trade, that the pullback becomes a correction here, then the target would be 181. In or around that number, which will be the 20 moving average. That will be a correction of about 4% from this point on. So we have two different trades here, a pullback trade or the correction trade. Which one do we go with? What is the entry strategy here? To find that out, we have multiple trades. We can pick naked puts. We can pick put spreads, calendar puts, diagonal puts, butterfly. We can do a lot of things here. And we can use a service such as OptionStrat or any other service that can show you a visualization of how the trade is going to play out. Of course, this is not really 100% accurate, and the reason is the implied volatility changes as the stock moves up or down. So what you're going to see right now is just an approximate table of how the trade is going to work out, but it's good enough for us to initiate the entry. So we know when we're looking for a pullback trade, let's say that we choose the December 15th expiration because this is the monthly expiration, the most liquid contracts will be in the monthly expiration. Likewise, if we're looking for a pullback of about 2.5%, we'll probably need about 2 weeks for that to work out. Anything more than 2.5%, you're probably going to take a longer expiration date. You have to go 4 weeks, 8 weeks. And of course, the monthly expiration dates are better than the weeklies because they have more liquidity. So with that understanding out of the way, we talked about 186 as being an important target for any pullback. We're probably going to find support in or around 186. So if we just look at the 185 puts, plain vanilla, naked 185 puts, December 15th expiration, the required move will be in or around 3%. The cost will be, as you can see here, $114, but that's for the entire contract. It's $1.14 a piece per option. And for the trade to be profitable by the expiration date, we need to see Apple down by 3.4%. As you can see in the expiration date, December 15th, if the stock is trading down by 3.4% at 183.5, the trade will be profitable by 32%. Looks okay, but let's try to reduce the cost a little bit, see if we can become a little more profitable here, since we're going to find support in or around 186-ish anyways. If we sell the 180 in this structure, same expiration date, the entry cost will go down to 69 cents a piece. And for the trade to be profitable, again, Apple needs to go down by about 3.5% or more by the expiration date. But if it just does the minimum move of 3.4% at 183.5 by the expiration date, the gains are now up from 32% to 129%. So we know that this structure is a lot better. Let's play with the numbers a little more. Let's go with the December 190 puts. Could that be a better choice if we pick closer to the money, or in the money in this case? Maybe we're not comfortable with Apple going down 3.5% in 2 weeks. Even though the move that we've seen so far is really excessive and the correction of an excessive move is probably going to be also large. But to be conservative, if we take 190, well, it's going to cost about, let's say, $2.67 a piece. A little more expensive here. And the stock needs to go down by the expiration date of about, let's say, 1.5% at around 187 at a minimum. And that will produce gains of about 12%. Can we increase the gains a little bit and reduce the entry cost, since we know that 185 will probably not be in the money since we have support in or around 186. Let's do that and sell the 185 along with buying the 190 puts. If we do that, the entry cost is down to about $1.59 a piece. For the trade to be profitable by the expiration date, we just need the stock to be down by about 1% in or around 188. And again, you can play with all of these. You can play calendar puts, butterfly puts, whatever structure you like. And then you pick that trade. And for me, when I look at the 190, selling the 185 puts, the put spread expiration date December 15th for about $1.60 a piece, I find the risk versus reward here is worth it. I'm not paying too much to enter, and I just need a 1% pullback for the trade to be profitable at a minimum. Now, is it worth playing the correction trade right now? On the weekly chart, it's going to go down to 181. And in that case, let's just say we go with the 180 puts, just a touch below 181, and we pick the next monthly expiration date at January 19th. Well, the trade is going to cost almost the same as the 190, 185 puts, the spread that we picked for December 15th. But in this case, you're going to need a drop worth about 6% in Apple by the expiration date Jan 19th for the trade to be profitable at around 30%. Now, a drop in the largest stock in the world by 6% or more, it seems to me as possible. But if you want to be in the safe side, if you want to be conservative, you're probably not going to bet on that. So I don't like the profitability here. So if we go back to the template here, I'm going to go with the pullback trade, and I'm going to go with the 190, 185 put spread with the expiration date December 15th. I'm going to pay about $1.59 a piece. What is my cut loss strategy? If we look at the chart once again, hourly chart, the whole premise behind the trade is we have broken the trend of higher highs and we have a bear flag pattern which will produce more losses in the stock. Well, if we go back to the highs again of 192.93, that's going to negate the entirety of the trade. It's not valid anymore. It doesn't matter if this happens tomorrow or 1 week from now. At any point, if the stock trades above 192.93, we gotta exit. At any time, goodbye. What about the time though? Suppose the stock just sticks around, does nothing at all. The question now becomes, when do we say, okay, is it time to cut the trade? Is it time to get out? And what that particular time would be? We go back to the table here. We pick halftime, so we have the expiration date December 15th. So halftime would be December 6th. So we know that December 6th, something gotta happen for us to keep the trade. Otherwise, it's probably a loser. Now, what is that something? We go back to the chart once again, the hourly chart. We need to see at least one more confirmation that this trade is worthy of holding on to. And that would be breaking the support of 188.57. So if we go back to 188.5, let's just look at that. By December 6th, if we break that level, would the trade be profitable or not? The answer is yes. So we know that we got it right here. If the answer is no, then we have to look at it again. We're missing something here. We need to see something before that. But we know that we're right because the trade will be profitable. So the time strategy, Apple must trade below 188.57 by December 6th. And now we can go back to the chart of Apple and you can mark your cut loss strategy. So you know the 192.93 at any time the trade is wrong. You got to cut the loss if we trade above that at any time. And then you can mark your confirmation, 188.57. We need to see that happening, breaking that level by December 6th. So now, even from a visual perspective, you're not lost here. You're not just throwing a dart or rolling a dice and hoping that's going to stick and produce profits for you. Now you have a template, you have a guide, when to cut loss. What do you need to see as a confirmation to know that the trade is working your way? How to enter the trade? What is the thesis behind the trade? What kind of trade should you be in? Pullback trade, correction trade, a chase trade, or an entry via conversion to stock trade? Which one is it? Now you know. Now you have a clear guideline here on how to construct a trade properly. And you're not lost. You know exactly what you have to look for. When to cut the loss, when the trade is working your way, by what time. And if you follow these templates and this kind of thinking, for any trade you enter, you're probably not going to blow up your account. It's impossible to blow up your account. And your trades from this point on will probably be more profitable than losing ones because there is a method behind the madness. Rather than swiping a few swipes and, yep, we have a trade now. What do we do? Now, the last part is the management strategy. What happens if Apple is trading indeed below 188.57 before or at December 6th? What do we do after that? Do we open a spread, book profits, double down, roll? That's the subject for another video. Now, here's your homework. If we look at the SPY daily chart, I am marking, of course, the previous stop from the month of July. So we have a call option trade here, which is the obvious one. Then we have another trade, which is if you look at the RSI and the action that we got this week with low volume, that there is a possibility that the SPY will go down in a pullback or a correction. You can choose the long trade, you can choose the short trade, you can choose a combination of both, such as using a put or short trade with a longer expiration date, then the hedge would be the long trade with a shorter expiration date, because right now the chart is not giving us a clear signal. As we see in Apple, it could go either way. So can you do a template for me here as your homework? For the SPY trade, give me a template for the chase trade, which is to 459.44. And then give me another pullback trade. And if you're really professional, give me a combination of both. If that's really too hard, we have another one for you, another homework, Tesla. Daily chart. We know that we're now within range, but a break below 230.61 will give us a put option trade, a short trade. A break above 242 will give us a long trade, aka a call trade. Can you give me a template for that? Can you fill the template and share it in Discord? So if you go to Discord, there is a channel called Options. I want you to go to that channel and post what you came up with. And then I'm going to come up with mine and share that with you on the daily video this Monday. Anyhow, folks, there is the Sunday video coming out soon, so stay around. But I hope this was helpful for you, and if it was, leave a comment. If it wasn't, then also leave a comment with feedback of what you want to see more. But hopefully, with this strategy, with this mentality in mind, we're not going to hear any more account blow-ups because, oh, you got in one bad trade all in, and now you're gone. Hopefully, that's going to stop at this point. With that, folks, this is all I got for you for this video, but stay tuned. The weekend video's coming out soon. I'll talk to you then. Take care.